afternoon, everyone. Good afternoon. How's everyone doing today? Good afternoon. It is another wonderful day. I'm going to give it a couple more minutes to allow some people to come in here, and then we're going to go ahead and get started. Hi, Chris. How are you today? Good to see you. Good to see you. All right, so we're going to go ahead and get started. So can everybody hear me? Can everybody hear me okay? Okay, so we're going to go ahead and get started. Now, so this is another hashtag get real woke, hashtag make it make sense, hashtag for the free. Today, we are going to cover part 2 of understanding the equity and debt in a corporate structure. As I told you guys in the last course, we're going to go ahead and do this pieces at a time. We're going to do it in small bites, so that way this can be understood really well, because this is probably the most important thing I'm going to teach you moving forward. And it's going to be the foundation for everything we do moving forward. As always, if you have any questions, please use the question mark icon in the bottom left-hand corner of your screen. When I'm done, I will open up the floor for a Q&A session, and we'll go ahead and take it from there. So let's go ahead and get started. Today's class is going to be, we're going to talk about debt today. So we're going to talk about how debt works in a corporation. And if you remember in the last class, we spoke on secured debt and unsecured debt when we talked about the order of payout in the event of a bankruptcy. So today I want to focus a little bit on the debt side of a corporate structure so you can kind of understand how this works. And so we'll start with secured debt, right? Okay, so in a secured debt situation, what tends to happen, the types of institutions that issue secured debt are like banks, financial companies that want to loan a company money directly. And what secured debt allows a lender to do is to file a lien against your company and or the underlying assets of the company. Like, let's say you have a warehouse, or let's say you have some real estate in your portfolio. They can put a lien on those things. And what they do when they file that lien, they usually file it in the county that the corporation is in, and in the state that the corporation does business, as well as in the state that they're incorporated in. And the reason why that is because it then sends out a public notification to anyone else that's going to try to lend to that company that company already has a debt obligation with someone else. So it allows them to be a part of the discussion when another lender wants to lend money to that company. And oftentimes other lenders are not really interested in lending money on the company unless the company has substantially high cash flows, or they can be able to, as we talked about in the last class, subordinate the current debt position so they can take the primary position in the event of a bankruptcy. They can get paid out first. So when you talk about secured debt, you're usually talking about what we call on Wall Street a credit facility. And what is a credit facility? A credit facility is a loan. It is a bank issuing you a contract. You sign the contract, you sign a note, and it gives them the ability to then record a lien based on that financing contract and that note, which allows them to collect their debts. And usually that note carries an interest rate. depending on the strength of the company, depending on the history of the company, depending on the FICO scores of the underlying guarantors. Because if you're a business that's been in business less than 2 years, generally you have to be a guarantor. These things will determine your interest rate. If you're a business that's been in business for longer than 2 years and you've been profitable longer than 2 years and you have a Dun & Bradstreet account set up and you've been generating a Paydex score, a Paydex score is like a credit score for business, then oftentimes what can happen is you're now in a position to be able to have your company borrow money without needing a personal guarantor. So now, when we talk about secured interest, what we want to talk about, because there are a couple of different ways that a bank can do this, right? So a bank can issue a credit facility that's either convertible or non-convertible. And so what does that mean? Let's say that, the bank lends you some money. They like your business. They believe that your business can grow and scale. And they believe that at some point your business will be able to go public, maybe sometime in the next 5 years. But they know that in order for you to be able to grow and scale the way you can, to be advantageous to an investment bank, to want them to encourage them to want to take you public, what they may ask you for is a convertible note. And what is a convertible note? It allows the lender, based on certain criteria and conditions that are signed in the loan contract, to be able to convert a portion or all of their debt position into an equity position in the company. That means that they are no longer a debt holder, they become a shareholder. And so what they're banking on is the ability to convert that debt to an equity position that would be worth more than the debt and interest rate that they would have charged you. And when a lender issues a convertible note to a corporation, the corporation then, as part of the conversion, has to issue what's called a warrant to the lender. And what is a warrant? What a warrant does is it is basically the company taking a percentage of their shares and putting them on hold so they can't sell those shares, because in the event that certain triggers are met in the loan agreement, they have to have the shares available in their equity position to be able to give the lender the shares that they're supposed to get. And so as the company is growing and they're issuing debt, the certain percentage of those shares, whatever was negotiated with the lender, cannot be sold. And to ensure that they're not sold, they issue the lender a warrant, which is the conversion right underneath the loan. And they freeze those shares, or what they call hold those shares in treasury, and to ensure that they can't be issued to anyone else until that warrant expires. Now, the interesting thing about a warrant is the fact that when you issue a warrant, the lender and you negotiate on what we call a strike price. And what is a strike price? It is essentially the price that the lender will be able to buy the shares at a later time. So let's say the strike price is, let's say, $20 per share. And let's say that at the time that they decide to convert to common stock, the shares are worth $40. Well, they still get to buy the shares at $20, and they realize a $20 upside immediately because they've converted, and because they converted at an agreed upon price previously. So that's what I mean when I say strike price. So warrants are negotiated at strike prices, and that's very important to understand. And that overall is how a convertible debt works. Non-convertible debt is very easy to understand. There's no conversion right. There's no warrant. It's just a straight across debt. You pay the interest. And at the time of maturity on the loan, let's say it's a 5-year loan, at the end of that 5-year period, you have to pay the principal back, right? Most loans issued to businesses are interest-only loans. So the business only pays interest, and then they have to pay the principal back at the time that it's due, at the time of the end of the loan. So if it's 5 years or 10 years, then you'd owe the principal back in 5 years or 10 years. So that is how secured debt works from a lender and from a corporation standpoint. Now, the other thing is, when you have a debt on your balance sheet, of course, that's a liability. So when a company owes someone else money, it's a liability on their balance sheet. And because it's a liability on their balance sheet, and because they owe a specific interest payment, it affects what we call their net operating income, because they have to commit a certain amount of money every single month towards the interest payment. Generally, a lender will tell a company, in order for them to be able to lend money to them, they usually want to see 1.5 to 2 times the interest payment in cash flow on a company's balance sheet. And the reason why that is because they want to make sure that if they're lending money to the company will be able to satisfy the interest payment while still being able to operate the business and still being able to invest money into the business to continue to grow the operations. Because, of course, if the business grows, then the company sees more cash flow and the lender is in a more secured position. So it is very rare, especially for a private business that's not publicly traded on the New York Stock Exchange or the NASDAQ, to be able to borrow at a lower rate than 1.5 to 2 times the cash flow position on the balance sheet. So that's very important to understand. You know, when you talk about lending with a financial institution, you have to make sure that you have sufficient cash flow to be able to pay the interest payment. And later on, as we continue to have these discussions, I'm going to talk to you about transactional profitability and what transactional profitability is and how that works, and how important it is for your business when you're considering starting a business or growing a business or scaling a business, that you have to always keep an eye to what's called your cost of goods sold number, so you can make sure you're always transactionally profitable. Because if you're making a profit every time you sell a product or a service, depending on that profit margin, you're in a much better position to be able to grow and scale faster. So now let's talk about unsecured debt. Now, unsecured debt's really interesting. Unsecured debt is usually a bond. And what is the difference between a bond and a credit facility? Let's talk about that. So as I told you, credit facilities come from financial institutions. They're direct loans with a lien against the company. A bond doesn't work that way. Most of the time, bonds are issued by publicly traded companies. So let's establish that first. Generally, a bond is issued by publicly traded companies. And what that means, those are companies that are traded on the New York Stock Exchange or the NASDAQ. But there are certain times where private companies are able to issue bonds into the market, because even though they're not publicly traded, they're very large. They've been in business for a while, and they have the ability and the confidence of the institutional community. They believe in them enough to believe that if they issue a bond, that they're actually going to be able to pay on it. Now, how does a bond work? What a bond is, so first and foremost, in order to issue a bond properly, you have to engage the services of an investment bank. Because what the investment bank does is they write what's called a prospectus. The prospectus outlines the risk, who the management is, what the operations of the business are, how it is, what the proceeds of the bond issue are going to be used for, and how it is that the business, based on their business model, is going to be able to satisfy the obligations of the bond, the what we call the coupon rate, or the interest payment. Coupon and interest are interchangeable, but when you're talking about a bond, you're talking about a coupon payment. That's how we call the interest in a bond. We call it the coupon. Whereas in a credit facility, we just call it an interest rate. But, let's not ever get confused by the terms that are used on Wall Street or are used on financial institutions. Understanding that they're one and the same thing is a very, very, very helpful thing, because it helps you not get confused. So coupon payment and interest are the same exact thing. Now, How this works is like this. Once the underwriter, or what we call the investment bank, so if you hear me say underwriter or investment bank, they're interchangeable as well, right? So the investment banks are the ones that underwrite or put out all the paperwork and do all the work and the valuation of the company to encourage the market to be able to lend money to this company. So they're underwriting the quality and credibility of the company. So they're called an underwriter. You've probably heard of underwriters if you've ever bought a house before, because in the same way that a bank underwrites a business and the strength and quality of that business is the same way that a bank will underwrite you and your strength and quality to be able to qualify for a loan for a house. At a later time, we're going to cover the 5 C's of lending, and I'll talk to you about underwriting and how underwriting works and what underwriters think about when they're considering lending you some money. Now, so as opposed to in a credit facility, or in a bond, as opposed to a credit facility where you're borrowing money directly from a financial institution, with a bond, you're borrowing money from people. So that could be like mom and pop. It could be like a pension fund. It could be an endowment. You are selling you're issuing a prospectus, and you're giving the people the opportunity to buy your bonds. They're buying with a bond because it's unsecured, because when a person buys interest or a bond from your business, they don't have the ability to file a UCC-1. Essentially, what a company's giving when they issue a bond is an IOU, a promise to pay. They're saying that based on our business, we believe that if you loan us money, we're going to give you this piece of paper, and we believe that we will be able to satisfy the interest payment every year as it's due. Now, with a credit facility, interest payments are usually paid monthly. In a bond, they're usually paid quarterly, semi-annually, or annually. And so that's a big difference between a credit facility and a bond. So usually companies only pay quarterly, semi-annually, or annually. Are there rare exceptions to that where a company will pay monthly? Yes. But as a general rule of thumb, bond coupon payments or bond interest is paid quarterly, semi-annually, or annually. Now, with that in mind, remember, they're giving you an IOU. So you are completely unsecured. You are banking on the good faith and credibility of that corporation and for their ability to be able to pay you. Now, when you deal with bonds, when an underwriter or an investment bank begins to look at the credit worthiness of a business, the first thing they want to know is if that business is investment grade rated. And what does that mean? Does that mean that Standard & Poor's, Moody's, and Fitch, which are the investment grade rating agencies, have they looked at that business and found that business credit worthy enough to give them a AAA rating or a AA rating or a BB rating, etc., etc.? If a company is investment grade rated, then of course they can issue their IOUs into the market at a cheaper interest rate. But if they're not investment grade rated, then what tends to happen is we call these high yield issues or junk bonds. They have to pay a higher interest rate to encourage people to want to take an IOU from them because they're considered a riskier investment. And remember, a few courses ago I explained that the more risk there is to an investment, the higher the interest rate or dividend a company has to pay to be able to encourage someone to want to invest. Interest rates and dividend payments are always commensurate with the level of risk in a business. So while you may be willing to take a higher risk, the higher the risk you take, the higher the return, yes, but the greater the likelihood that you may not see the return because the company doesn't have the ability to satisfy their obligations. So it's very important that you match your returns to your personal risk profile, the level of risk that you're willing to take. And as a business, if you're the business owner, you have to make sure that the level of interest rate that you're paying is properly commensurate to the risk, but more importantly, is something that you'll be able to satisfy long term, because the last thing you want to do is default on a bond obligation. Once you do that, it makes it very difficult for you to issue bonds in the future, especially if it's the first bond issue you've ever done, because you lose the confidence and credibility of the market. So that's very important. Now, when we talk about bonds from a corporate standpoint, there's a couple different ways that they can issue bonds. One, they can issue a callable bond. What is a callable bond? A callable bond means that they've issued it at a certain coupon payment at this point in time based on their current risk profile. But at a later time, as their risk profile gets better, they'll be able to call the bond back, basically take the bond back and reissue you a different bond at a lower coupon rate. What this does for the business is it gives them the opportunity, as they grow and scale and gain credibility in the market, to be able to take advantage of their new credit-worthy standing and be able to recall and lower the interest rate to the bondholders, so that way they're able to manage their cash flows better, right? The risk on this side, though, is that initially to issue a callable bond, of course, because they have the ability potentially to call the bond back and issue the bondholders a lower coupon payment or a lower interest rate later, they have to pay a higher interest rate up front, because they have to compensate the bondholders up front for the potential risk that the bond could be called later and that the bondholders would get a lower interest payment at a later time. So that's very important to understand. So some companies do issue callable bonds. Generally, callable bonds, they're not really a thing that's popular or in demand. And a lot of investors don't like callable bonds because they don't want to, they like consistent, people that issue or invest in bonds like consistent, predictable cash flows. And so if they know that their potential cash flow can go down at a later time, they generally tend not to be interested in that. But there are companies and individuals that do invest in callable bonds. The second type of bond they can issue is a non-callable bond. This is just a straight across bond. So whatever the coupon payment that they issued at the beginning of the issue is the coupon payment that it's going to be for the entire term of the bond, be it 5 years, 10 years, whatever the case may be. Now, inside of callable and non-callable bonds, you also have convertible and non-convertible bonds. And convertible and non-convertible works the same way as it does in a credit facility. The same warrant principles, the same everything that I just explained in the credit facility process is exactly how it works in the bond world. Now, a bond can be callable and convertible. It can be callable and non-convertible. It can be non-callable and convertible. It can be non-callable and non-convertible. So, there's different, I guess you could say, for lack of a better word, machinations or different ways that you can put together a bond package to encourage investors to want to participate. So when you considering issuing IOUs as a business, you have to understand the market, what the market appetite is for bonds in general. If you're not investment grade rated, you have to consider what the appetite is for non-investment grade high yield bond issuance, and what the market interest is in either a callable, non-callable structure. The goal is to create something, when you're doing bond issuance, to create a bond that's going to benefit your business and free up as much of your cash flow, or not tie up as much cash flow as possible, while still being appealable to the market, so people will actually buy your bonds and give you the money you need to grow and scale. And it's usually investment banks that help out with this. Now, the cool thing about bringing an investment bank into the situation is the fact that if the investment bank has a lot of confidence in what you're doing, they will market your bond issues to their clients. Other investment banks will join in what's called a syndication, and we'll talk about this more when we talk about initial public offerings and how they work. But they'll join in together in a syndication or a group of investment banks working together to sell your bond issue to their clients and relationships that they have both in the United States and internationally, because a bond can be sold all over the world, and there are investors that are interested in investing in bonds from U.S. companies all over the world. So your bonds are not just what we'll say captive or only issued for United States investors. They're also available for the international community as well. So you get a wide reach when you're issuing a bond and working with the right investment bank. So that's really important to understand too. So those are the general things that I wanted to cover today. Those are the few basic kind of things I wanted to go over in the debt structure to help you understand how it works in practicality. You know, it's easy to talk about theory, but how does it work in a real world situation? So I just wanted to kind of share that information with you guys today. If anyone has any questions on what I went over currently, now is the time to ask questions. So I'm going to give it about 30 seconds to a minute here to give people the opportunity to ask questions. Now, know that, as I always say, there's no dumb question here. The only dumb question is the one that you do not ask. The goal here is to make sure that you guys understand this process very, very, very well, because you're going to have to consider these things as you start a business and as you begin to grow a business. As I always say, and as I will teach you as we go forward in this situation, from day one that you start a business, you're starting your business to scale. So you have to be looking long term, and you have to be thinking about, how your business is going to grow, how it's going to scale, and more importantly, how you're going to attract the capital you need in your business to be able to operate your business strategies and execute your business strategies in a way that is going to create capital and growth for your business, because that's the goal. And the other thing that you have to be thinking about when you're starting a business is how you're going to exit that business, right? One of the most important things you can do is not marry your business. A lot of business owners, when they first start, they marry their businesses in a way that, they feel like they put their blood, sweat, and tears in it, and they never want to sell it, and, they want to hold on to it forever, and that's great. But the reality of the situation is this, right? If someone's offering you a high enough price for your business, it can be sold. If your business can be sold in the public markets, if you can issue shares and do an IPO, that's a smart thing to do. So you either exit public or you exit private, but you're always thinking about the exit. I think a lot of people, when they initially start businesses, they're afraid that, if someone buys the business from them, then how are they going to make more money? How are they going to do what they're able to do? The cool thing is, when you sell a business, you're selling the business. You're not selling you. And the same knowledge and skills and experience and execution strategies that you have, your ability to be able to execute, that stays with you. So just because you don't own that business anymore, it doesn't mean that you can't start a business in a same, similar, or a completely different industry and still be successful. Because at the end of the day, the knowledge base you had, the experience that you have, the execution ability doesn't change. No matter what industry you're in, your work ethic doesn't change. Those things stay with you, and no one can ever buy that from you, and no one can ever take that from you. It's yours forever. And so that's a very important thing to understand, when you're building a business and someone's offering you a high multiple for your business, So always think about that. And sometimes, a person may come and say, I think your business is worth $1 million, but I want to buy it for 10. That's great. But then you also have to ask yourself the question, if you're willing to pay $10 million today, what do you see in my growth prospects that I haven't considered? And so sometimes it's okay to say no for a year or two, so that way you can continue to grow and maybe sell your business for 50 or 60 or 70 million dollars. So sometimes it's not smart to take the first offer, but that depends on where your business is, where you are, and what your ultimate goal is for yourself personally, for your family, and for that business. But you're always looking towards the door. What is my exit? How do I get out of this business at the multiple or the sales price that I want to get out? So I see a question here. It says, what would you invest with your last $1,000? I would invest in myself. I will bet on myself 100% of the time. And the number one investment that you can make, no matter what you're doing, is in yourself. And after you invest in yourself and you're able to, generate the types of income you want to generate based on your knowledge, experience, and execution, you're going to learn along the journey a lot of tangible and intangible things that are going to help you with generating passive investments like real estate, like cryptocurrency, like index funds, like commodities. The knowledge and experience that you have is what's going to make you good at making and analyzing and deploying capital into strategic passive investments, But as I said in another video, and I'll say it in this video too, there are two things you need to succeed in business and life in general. The first thing is core belief. 90% of your success in this life is based on your core belief. And so before you invest in anything, before you start in anything, you have to have a certain level of core belief. And what do I mean when I say core belief? And this is something I explained before, but I'm going to explain it again. Core belief is unshakable. It means that you believe in you no matter what anybody else is telling you. They're going to come along your path, along your journey when you're starting a business, when you're trying to grow and scale. There are going to be a lot of people that tell you can't do it, that you're crazy, that you should give up, that you should quit. And if you allow those people to dictate what you're going to do, you are allowing these people to dictate your outcomes. If you allow a person to get into your mind, to be able to manipulate your mind and take you away from your own strategy, once you give a person control of your mind, you give them control of everything you are and everything you will ever become. So before you do anything, you have to search within yourself and find out who you are and have a core belief and confidence in that. Because 90% of your success in life, 90% of your success in business is an unshakable, unmovable core belief in you. You will bet on yourself 100% of the time. And while you may not be able to get exactly what you want in the timeline that you wanted, eventually you're going to get everything that you want, because you're not going to stop until you get it. You're going to do what you have to do. You're going to make whatever sacrifice you have to make, whatever investment you have to make. You're going to do it. The other 10% of success in this life is strategy. You truly have to plan all the way till the end in life and in business. You have to plan it all the way through. You have to be able to understand where you are, where it is you want to be, and you have to hold yourself accountable by setting milestones and mile markers along the way. So as you're building and growing, you're saying, in 3 months I want to be here, in 6 months I want to be here, in 9 months I want to be here, in a year I want to be here. And so when your first milestone, your first mile marker comes up, you take an honest assessment of your business and of yourself personally, and you see if where you thought you were going to be in 3 months is where you actually are. And if you're not, then you need to stop. You need to sit down. You need to take an honest assessment and reassessment of your situation and figure out what changes you need to make to be able to get where it is you want. So by the time you're looking at your 6-month marker, you're on par with where you thought you would be. See, so that's strategizing. That's planning all the way till the end. But the truth of the situation is that if you don't have core belief in yourself, right, you won't be able to strategize properly. You won't be able to see through the fog of doubt, worry, negativity, fear, these things that prevent you from being able to overcome the obstacles that you're going to have to overcome to be able to find the level of success that you really want to find, right? And so what tends to happen is, if you can't see through the fog, you can't properly strategize. And if you can't properly strategize, you'll never be able to properly execute. And you'll find yourself in failure. But the truth of the situation is, even though 10% of your success in life and in business is strategy, if you don't have core belief, you can't strategize. So the truth of the situation, when you really, really look at it, 100% of the success that you're going to find in this life and in business is core belief, because nothing else functions without core belief. So I just wanted to share that with you guys, because I think that's very, very important as we continue these discussions, that you always keep that in the forefront of your mind. You got to believe in you before you believe in anything else. So to answer your question up to Pt-2, I can tell you that if I had $1,000 and it was my last $1,000, and where am I going to invest it? I'm going to invest it in me. I'm going to invest it in an idea and a strategy that I have, that I believe in, that I believe that I can execute on. And when I put that last $1,000 in, right? When I put that last $1,000 in, I'm going to put in all the time and effort that is necessary to ensure that at the end of the day, I recoup that principal plus the return that I wanted to be able to get. I'm not going to stop, because I'm betting on me. And I'm never going to fail me. Other people may fail me in this life. And what you're going to find along this journey is people are going to let you down 1,000 times over. Don't ever let yourself down. And the only way you don't let yourself down is that you keep moving. Yeah, you're going to fall sometimes. Yeah, it's going to hurt. Yeah, you're going to make mistakes. Yeah, you're going to fail a few times. Heck, I did. You're going to go through a lot along the journey towards success. But you truly fail your way to success. Anybody that's been successful in this life is a product of failure. They failed their way all the way to success. That's what they did, right? Business sucks until it doesn't. It's not profitable until it is. And the only way it gets profitable is if you keep working and grinding and learning the lessons and applying the lessons that you're learning from these failures to be able to set yourself up for success at a later time. And that is reality. That's how this works. There's no book you're going to read that's going to make you successful. They may help with your knowledge base, but overall, they're not going to make you successful. You're not going to wake up and be successful in one day. This is going to be a journey, and you have to be willing to take the journey. But it starts with believing in yourself and investing in you and doing whatever you have to do, whatever it takes, of course, within the right side of the law, to be able to find that success. So I just wanted to share that with you guys. Again, if anybody has any questions, I'll open the floor for questions. Thank you for the question up to. That was a great question, and I'm glad that you asked it. Does anybody else have any questions? Okay, so it doesn't look like anybody else has any questions, so I'm going to end here for the day. As always, y'all know how I do. I got to do my thing. Like, subscribe, follow, share. Share this information with anybody that you think can benefit. The more eyes we get on the content, the more people will be able to benefit from the information being provided in these conversations. Another thing that I want to say that I'm going to learn to say now, I'm learning things as I go along here. It's a process. Got to learn some things, right? So another thing that I'm going to say is turn on your notifications so you know when I go live. You guys know I go live every Sunday at 3 p.m. However, there are times during the week that I do go live, when I have a little bit of time just to share a little bit of information. So if you turn on your notifications, you'll know when I'm live so you don't miss this information. Of course, I'm going to save this live to my Instagram feed so that way you guys can watch it. And those that were not able to make it at this time because they had other commitments can watch it at a later time. As always, I appreciate y'all. I thank you for taking the time to allow me to speak to you. And I'll talk to you guys next Sunday or potentially sooner if I have a little time. You guys have a great day.